Listen, welcome back. Happy Mindset Monday. It's your girl, Chrissy Pips. Now, in today's video, we're going to jump right into our third book, which is Trading in the Zone by Mark Douglas. Now, in chapter 1, we're going to be going over the road to success. Now, please don't forget to hit like if you enjoy the content in this video, subscribe so you don't miss out on what's next, and comment and share on social media if you think others can benefit from this info. But as always, if you're here, you're interested, so let's get into it. Now, I'm not going to go into great detail about the different types of analysis, but briefly, fundamental analysis tries to take into account all of the variables that could affect the balance or imbalance between supply and demand in the markets. It uses mathematical equations to calculate different factors. Now, these models were meant to project where price should be or could be in the future. Now, fundamental analysis forgot to incorporate other traders as one of the variables. So people like expressing their beliefs about the market is actually what makes it move. Now, fundamental analysis does you no good if other traders are not aware of or do not believe in this type of model. Many futures traders are not even aware of the fact that supply and demand supposedly moves price. They trade off emotion. It creates a reality gap between the two. Now, technical analysis is knowing that a finite number of traders exist in the market at any given day, week, month, year, and understanding how valuable that info is to you as a trader. Okay? Many traders have behavior patterns, and groups of people interacting with each other on a regular basis will have a collective behavior pattern. Now, you can also observe and calculate these behaviors. These behaviors repeat themselves with statistical reliability. This method organizes behavior into identifiable patterns. This allows you to see which is the higher probability of a thing happening or not happening over another based on things that have happened in the past. It helps you to possibly predict future price movement based on patterns from the past. There's a huge gap between what you understand about the markets and your ability to mold that knowledge into consistent profits. Have you ever looked at the charts and made a hypothesis of what you thought was going to happen, and then it actually happened, and because you weren't able to get in, you sat there and pouted about how much you should have or could have made? There's a big difference between making a prediction and making a prediction and then taking action on that prediction. Mark Douglas calls this a psychological gap. Although it may be hard to master mental analysis, it is definitely possible. The entire purpose of the book, Trading in the Zone, is to help us bridge the gap between mental and technical analysis while helping us to become consistent, profitable traders. Helping us to think like a trader and attain a trader's mindset, giving us a unique set of attitudes that allows us to remain disciplined, focused, confident, and diligent in spite of any of the market's adverse conditions. This book is going to give us a hell of an attitude adjustment. And this book is going to help us understand ourselves and the nature of trading so that trading becomes easy, simple, and stress-free. Right now, what type of trader are you? Now, anyone can put on a successful trade, but the difference between those people and successful traders is huge. The two groups are as different as night and day. The market is consistently making money available to you as a trader that can be used to create a successful trade. But since the market is also constantly flowing, which makes the possibility for success magnified and seemingly within your grasp. There are some people who make trading seem so easy that it looks like money flows into their account constantly and effortlessly. It's a mind-boggling thing. For others, it seems like the money is within their grasp, and these are moments of enlightenment in those like traders' abilities. But the constant thing about those types of traders, like the second type of trader, is the constant or consistency of emotional pain. Most of the time, they're in a state of fear, anger, frustration, anxiety, disappointment, betrayal, regret. And it doesn't help them as far as the things that they want to do in the market, right? So what separates these two groups? Intelligence and good market analysis can definitely contribute to success, but are not the defining factors. In fact, some of the smartest people are some of the worst traders. It simply boils down to one thing. The best traders think differently from everyone else. Now, what does it mean to think differently? We assume that other people share our perceptions of specific events, but that only holds true until we disagree with someone who has experienced something similar to us or experienced the exact same thing we have. Now, the way we think is what makes us unique, but the best traders work well in adverse psychological situations. They have attained a certain level of mental toughness, right? Learning to identify high probability entry and exit points in the market does not mean that you have learned to think like a trader. An attitude that allows you to remain disciplined, focused, and confident in spite of any of the market's adverse conditions is a much better way to define it. Consistency or lack of it comes from attitude. Now, they also experienced a large amount of emotional and financial pain before they fully gathered this information and got to this point, but they still got there, and that's the point. Now, there are a few exceptions of people who didn't have to experience this because they were born into families that already had good traders in it, so they had a good support system to teach them along the way. And there are people who just had excellent mentors who were good at teaching them to become traders. Now, trading is full of paradoxes and contradictions in thinking that make attaining this attitude challenging, but I'll help you with that. Many of the perspectives, principles, beliefs, and attitudes that would normally work well in our day-to-day living situations have the opposite effect in the trading environment. Not knowing this puts you at a disadvantage at the beginning of your trading journey, but we will make it through. Now, trading is risky and no trade has a guaranteed outcome. When you put on a trade, do you consider yourself to be a risk taker? That's not a trick question, I promise. The logical answer is yes, because if you take part in a risky activity, you must be a risk taker, right? Well, there is a reasonable assumption there, but the problem is that this assumption is not exactly correct at all. All trades are risky because the outcome is probable and not a guarantee. But have you fully accepted the possibility or the different consequences that come along with putting on a trade? The answer is no. Most traders have no concept of accepting and embracing the risk. The best traders can easily put on a trade and easily admit when the trade needs to be closed, even if it's with a loss. And they do it while showing no fear. The risk involved in trading does not cause the best traders to lose focus or concentration. Whatever degree you haven't accepted the risk is the same degree you will go to stay away from that risk or avoid that risk. Now, you can avoid the unavoidable, right? No, not really. You can't avoid the unavoidable. After dying in public speaking, people are most afraid of losing money and being wrong. Your intuition and emotions try to help you avoid discomfort. This process is what keeps you from being successful. Learning to accept the risk is the most important trading skill you can learn. You need to have an objective perspective, right? So no bias. The market can't control how we perceive the information or control the action or inaction we take. That's all on us. The best traders aren't afraid because they can flow into and out of trades based on their perception of the market and still will not become reckless. Now, being wrong, losing money, missing out, and leaving money on the table are Mark's 4 primary trading fears that he goes over in his book. Now, these fears act on your perception of the market information that will cause you to take action that will end up making you wrong. So if you constantly think about what you don't want to happen, your perception is going to switch so that you can only see the things that line up with making that perception or that fear come to fruition. Fear is immobilizing and causes us to narrow our attention on what we don't want. Then you have to wait for those hindsight is 20/20 moments to actually see where you went wrong. Now, this trading psychology book will help us get over these things and teach us a lot about who we are and who we would like to become. Now, we will learn to control our perception, our beliefs, and our attitude so that we can become consistently successful. We are the hardest part of trading. But that's going to end today's video. In the next video, we're going to step into chapter 2, which is the lure of trading. Now, check out the 101 Wednesday video series. Since we're tucked safely away in our homes, might as well learn something new, right? So I'll see you over there. And as always, please don't forget to like if you enjoy the content in this video, subscribe so you don't miss out on what's next, comment and share on social media if you think others can benefit from this information. But as always, I hope you guys are having an awesome and productive day, and I'll see you in the next video. Bye.